Listen up, because I'm only going to say this once. You don't need a PhD in finance to be a successful investor. In fact, sometimes less is more. The world of investing can be overwhelming with its myriad of options and strategies. That's why I'm a huge proponent of the one ETF portfolio, especially for long-term investors. It's a strategy that simplifies your investment journey. This strategy is exactly what it sounds like. You pick just one exchange-traded fund, ETF, and go all in. No more juggling multiple investments. Yes, you heard me right. One ETF to rule them all. It's about focusing your efforts and resources on a single, well-chosen fund. It might sound crazy, but hear me out. This approach is not just about simplicity, it's about efficiency and effectiveness. This approach is all about simplicity, low cost, and long-term growth. By reducing complexity, you can focus on what truly matters. Forget about complex investment strategies and trying to time the market. Timing the market is notoriously difficult and often leads to stress and suboptimal returns. With a one ETF portfolio, you're investing in the entire market, and that's a powerful thing. It's like having a slice of the global economy in your portfolio. Think of it like this: why buy individual stocks when you can own a tiny piece of thousands of companies with just one purchase? It's diversification at its finest. That's the beauty of ETFs. They offer a simple yet effective way to diversify your investments. They give you instant diversification, spreading your risk across a wide range of assets. This reduces the impact of any single investment's poor performance. No need to stress over individual stock picks or sector rotations. You can relax knowing your investment is broadly diversified. This strategy is perfect for beginners who are just starting out, providing a straightforward path to investing, or for seasoned investors who are tired of the headaches that come with managing a complex portfolio. It's a breath of fresh air in the investing world. It's low maintenance, cost effective, and most importantly, it works. Lower costs mean more of your money stays invested and working for you. So buckle up, because we're about to dive deep into the world of one ETF investing. Get ready to simplify your investment strategy and achieve your financial goals with ease. Now, you might be thinking, Jim, isn't diversification a good thing? And you'd be right. But just like anything else, you can have too much of a good thing. When it comes to investing, over-diversification is a real problem. Many investors fall into the trap of thinking that more ETFs equal more safety and higher returns. But the truth is, spreading yourself too thin can actually hurt your portfolio in the long run. Think about it. The more ETFs you have, the more fees you're paying, eating into your potential profits. Not only that, but too much diversification can water down your returns. By trying to own a piece of everything, you end up diluting your exposure to the market's biggest winners. Remember, some of the greatest investors in history, like Warren Buffett, built their fortunes by making concentrated bets on a select few companies. So before you go out and buy every ETF under the sun, remember this: simplicity is key. Focus on finding one or two high quality broad market ETFs that align with your investment goals and risk tolerance. Don't fall into the trap of over diversification. When it comes to a one ETF portfolio, we're not talking about just any ETF. We're talking about the big leagues, the heavy hitters, broad market ETFs. These bad boys are like the all-star team of the ETF world, giving you exposure to a wide swath of the market in one fell swoop. Think of it like this. Owning a broad market ETF is like owning a tiny piece of the entire stock market. You're not betting on any one particular company or sector. You're betting on the overall growth of the economy. And historically speaking, the market has always gone up over the long term. This means that by holding a broad market ETF, you are essentially riding the wave of economic progress and innovation. And there are a few key reasons why broad market ETFs are ideal for a one ETF strategy. First, they offer unparalleled diversification. These ETFs hold hundreds, even thousands of stocks across all sectors, so you're not putting all your eggs in one basket. This means that if one sector underperforms, others may pick up the slack, balancing your overall returns. This diversification helps mitigate risk and smooth out your returns over time. By spreading your investment across a wide array of stocks, you reduce the impact of any single stock's poor performance on your portfolio. Second, broad market ETFs are incredibly low cost. Because they track a specific index, they require minimal trading and management, resulting in lower expense ratios compared to actively managed funds. Lower costs mean more of your money stays invested and working for you. So if you're looking for a set it and forget it investment strategy, a one ETF portfolio with a broad market ETF is the way to go. This approach allows you to benefit from the overall growth of the market without the need for constant monitoring and adjustments. Section 4, the big three, VU versus VTI versus VT, head-to-head matchup. All right, now let's cut to the chase. You're convinced that a one ETF portfolio is the way to go, but which ETF should you choose? Don't worry, I've got you covered. In the world of broad market ETFs, three titans reign supreme: Vanguard S&P 500 ETF, VOO, Vanguard Total Stock Market ETF, VTI, and Vanguard Total World Stock ETF, VT. First up, we have VOO, tracking the S&P 500 index. This ETF gives you exposure to 500 of the largest publicly traded U.S. companies, representing about 80% of the total U.S. stock market capitalization. It's a solid choice for investors who want a simple and effective way to track the performance of the U.S. market. Next, we have VTI, which broadens the scope by tracking the entire U.S. stock market, including small, mid, and large cap stocks. This ETF provides even greater diversification than VOO, capturing the growth potential of the entire U.S. equity market. It's ideal for those who want to invest in a broader range of companies, from the giants to the up-and-comers. And finally, we have the globetrotter of the group, VT. This ETF tracks the performance of the entire global stock market, including both developed and emerging markets. It's a fantastic option for those who want to diversify beyond the U.S. and tap into the growth potential of international markets. If you're looking for the ultimate in diversification, VT is your go-to ETF. It's perfect for investors who want exposure to the global economy and are looking to spread their investments across various regions and sectors. Section 5, picking your champion, risk, return, and what matters to you. Now that you know the contenders, let's break down the key factors to consider when choosing the best ETF for your one ETF portfolio. Risk tolerance. How much volatility are you comfortable with? If you're risk averse, VOO, with its focus on large cap US stocks, might be a good fit. If you're comfortable with a bit more risk and potential for higher returns, VTI or VT, with their broader market exposure, could be more appealing. Investment horizon. When do you plan to retire or need access to your investments? If you have a long time horizon, VT with its exposure to emerging markets might offer the greatest growth potential over the long term. Investment goals. What are you saving for? If you're saving for retirement, a broad market ETF like VTI or VT can provide the foundation for a well-diversified portfolio. Ultimately, the best ETF for you depends on your individual circumstances and investment objectives.